Most people in the UK think building wealth is complicated, but the truth is, it comes down to one simple idea: buying assets and letting them compound over time. And the two best tools we have for that in the UK are the stocks and shares ISA and your pension. Today, I'm going to break down exactly what that means in plain English and show you how normal people can use these accounts to grow wealth quietly in the background. So, what does buying assets actually mean? When people say buy assets, they're not talking about fancy investments or being rich already. They simply mean buying things that are designed to go up in value over time. Think of things like shares in companies, index funds, ETFs, or bonds. Property also counts if you own it. Inside an ISA or a pension, you're usually buying funds, which are basically big baskets of hundreds of different companies. This is great because you don't need to try and pick individual winning stocks or gamble your money away. You're spreading your risk and buying a piece of the whole market. Here's where it gets really interesting. In the UK, the government gives us two accounts that are basically legal tax shelters designed to help us build wealth. First, you have the stocks and shares ISA. With this, you pay no capital gains tax on your profits, no dividend tax on your earnings, and no tax at all when you withdraw your money. You don't even have to report it to HMRC. It's a completely tax-free wrapper for your investments. Then you have your pension, whether that's a workplace one or a SIP-HEAP, a self-invested personal pension. With pensions, you get tax relief on your contributions, which is like getting an instant bonus from the government. Your employer often adds money in too, which is literally free money. And just like an ISA, your investments grow tax-free inside the pension. You can then access this money from age 55, which will rise to 57. These accounts are specifically designed to help your money grow faster because you're not losing big chunks of it to tax along the way. Now for the magic ingredient: compounding. This is the part that, for some reason, nobody teaches us in school. Compounding is when your money earns money, and then that new money starts earning its own money, and the cycle just keeps going. It creates a snowball effect. If you invest consistently, even small amounts, compounding turns time into your biggest advantage. This is exactly why truly wealthy people aren't chasing quick wins or risky bets. They buy good assets, they hold them for a long time, and they let compounding do all the heavy lifting for them. And this strategy absolutely works for normal people. You do not need to be rich to start. All you need are a few simple things. First, a stocks and shares ISA. Second, a pension that you're regularly contributing to. Third, a simple low-cost investment, like a global index fund that tracks the world market. And finally, you just need time. That's it! You're not trying to beat the market, you're not day trading, and you're certainly not gambling. You are building wealth the exact same way the wealthy do, slowly, quietly, and consistently over the long term. So, the next time you hear people talking about buying assets or compounding, this is what they mean. You put money into a tax-efficient account, like an ISA or a pension. You use that money to buy investments that are designed to grow over time. Then, you leave them alone and let the power of compounding do the rest. It's simple, it's incredibly powerful, and it's available to absolutely everyone in the UK. If you want more videos breaking down money myths and the hidden financial systems in a way that actually makes sense, hit that subscribe button. This is Money Unmasked, empowering normal people with knowledge. Ever wondered how people in the UK actually build wealth? Forget the get-rich-quick schemes, the complicated trading, and the idea that you need to be lucky. The real strategy is surprisingly simple, and it's something anyone can do. It all comes down to one core idea: buying assets inside a stocks and shares ISA or your pension, and letting them compound over time. Today, I'm going to break down exactly what that means, in plain English, and show you how normal people just like you and me can use these accounts to grow wealth quietly and consistently in the background. This isn't financial advice, but it is financial education, designed to empower you with knowledge. So, let's start with the basics. What does buying assets actually mean? When you hear this phrase, don't picture someone in a top hat buying a skyscraper. It's much simpler than that. An asset is just something that has the potential to make you money or increase in value over time. We're talking about things like shares in companies, bonds, and property. But for most of us, we're not going out and buying individual stocks like we're on The Apprentice. Instead, inside an ESA or a pension, you're usually buying funds. Think of a fund as a big shopping basket that holds tiny pieces of hundreds or even thousands of different companies from all over the world. The most common types are index funds, or ETFs, which are just low-cost funds that track a whole market, like the FTSE 100 in the UK or the S&P 500 in the US. By buying a global index fund, you're essentially betting on the long-term growth of the global economy, not gambling on one single company. This diversification is key. It spreads your risk, so if one company does badly, it doesn't sink your entire investment. So, buying assets simply means putting your money into these diversified funds. Now, here's where the magic really happens. Why are ISAs and pensions so powerful? In the UK, the government gives us two incredible tools that are basically legal tax shelters. Let's look at the stocks and shares ESA first. You can put up to £20,000 into an ESA each tax year. Inside this account, any growth your investments make is completely free from capital gains tax. Any income you get from dividends is also tax-free. And when you decide to take your money out, guess what? Also completely tax-free. You don't even have to declare it to HMRC on a tax return. It's a beautifully simple, tax-efficient wrapper for your investments. Then you have your pension, whether it's a workplace pension your employer sets up or a personal one you open yourself, called ASIPP. Pensions are a bit different but just as powerful. When you put money into your pension, you get tax relief. This means if you're a basic rate taxpayer, for every £80 you put in, the government adds £20, instantly turning your contribution into £100. It's like getting an immediate 25% boost on your money. If you're in a workplace scheme, your employer is also legally required to contribute, which is, literally, free money. Just like an ESA, your investments inside the pension grow free from capital gains and dividend tax. You can't touch this money until you're older, currently age 55, rising to 57 in 2028, but that's the whole point. It's for your future self. These accounts are specifically designed to help your money grow much faster than it would otherwise, because you're not losing big chunks of your returns to tax along the way. This brings us to the most powerful force in finance, something Albert Einstein supposedly called the eighth wonder of the world: compounding. This is the concept they criminally forget to teach us in school. Compounding is simply when your money earns money, and then that new, slightly bigger pot of money earns even more money. It creates a snowball effect. Let's imagine you invest £1,000 and it grows by 10% in a year. You now have £1,100. The next year, you don't just earn 10% on your original £1,000. You earn it on the full £1,100. So you make £110. The year after, you're earning returns on £1,210. It might seem slow at first, but over 10, 20, or 30 years, this effect becomes incredibly powerful. Time is the secret ingredient. This is precisely why wealthy people don't chase quick wins or gamble on risky trends. They understand that true wealth is built by buying good assets, holding them for a very long time, and letting compounding do all the heavy lifting for them. It's an automatic, passive process that works 24/7, even while you're sleeping. So, how does this actually work for normal people? You don't need a six-figure salary or a huge inheritance to get started. The barrier to entry is lower than it has ever been. All you really need are 4 things. First, a stocks and shares ESA, which you can open online in minutes with very little money. Second, a pension that you're regularly contributing to, especially a workplace one to get that free employer match. Third, a simple low-cost investment to put inside these accounts, like a global index fund. And fourth, the most important element, time. You need the patience to let your money grow over years and decades. That's it. Notice what's not on this list. You're not trying to beat the market. You're not trying to find the next 10-bagger stock. You are simply participating in the market, letting the natural long-term growth of the economy work for you. You're building wealth the same way the wealthy do. Slowly, quietly, consistently, and with discipline. Let's put it all together. The simple, proven strategy for building long-term wealth in the UK is this. You regularly put money into your tax-sheltered accounts, your ESA, and your pension. Inside those accounts, you buy diversified, low-cost assets like a global index fund. Then, You leave it alone. You let it sit. You let it grow, and you let the power of tax-free compounding work its magic over many years. It's simple. It's powerful! And it's available to every single person in the UK. This is the real path to financial independence. Not some secret trick, but a clear, actionable plan. If you want more videos that break down money, investing, and the hidden financial systems in a way that actually makes sense, make sure you hit that subscribe button and turn on notifications. This is Money Unmasked, empowering normal people with knowledge. Thanks for watching.